Candlestick, bullish or bearish, is the question which comes to everyone's mind, whether you are a beginner or experienced person, because there are so many types of candles we get to see on the daily chart. So if you start understanding the candle character, then it becomes pretty easier to understand how the market is moving, and based on that, you can take a successful trade. So I'm going to discuss in the next 30 minutes briefly, as the subject is very big. I'll be able to cover whatever is possible in the next 30 minutes or so. So keep watching. Good morning, Namaskar. I'm Divakar. Welcome to the Bulls and Bear Bulletin. And today I'm going to discuss mainly on the candlestick uh, pattern on the bullish or bearish. So before that, let me just brief you quickly on the topics which I'm going to discuss today. Before we explore any trade, it's important to know the Nifty and Bank Nifty technicals, and then we'll need to know the global market scenario and how it can impact the Indian market today. And also, you should check the broader market picture to understand how the sentiment is looking at that moment. And then option chain, of course, we get to know the important support and the resistance level of your stock or index. And of course, today's main topic, candlestick bullish and bearish. And I'll continue to discuss on two of my favorite option strategies, bull spread and iron condor, if time permits. And so let me just take you first on the Nifty and Bank Nifty technicals. Well, if you see here on the Nifty chart, the Nifty made an all-time high of about 26,300 level on the last week of September and started declining from there. Initially, you can see the green big candle here suggested there is uh, a bounce back from this level, and suggested the correction is over and the bull run might be resuming once again. But we were wrong, as it took resistance around 24,600 level and started declining once again. Well, this time it went on making newer lows, and the new low for the season was around 21,980 level. And by this time, if you could see, the RSI indicator was on its lowest, and suggested it's on the oversold scenario. Even the MACD was extremely on the lower level, and so we were sure the market would bounce back from this level, and that's what exactly happened. And it started climbing up. However, it took resistance around 23,800 level and started declining. This time, the market was influenced by the global market scenario on the tariff, and went down aggressively and tried to break the previous season low. And however, it was only about a couple of 100 points from the previous low. And from here, you can see the market bounced back aggressively this time, and comfortably breaking the resistance level of 23,800 level, and went on making newer highs. And this time, it went and crossed the 25,000 mark. And from there, actually, we are seeing the market is struggling between 25,500, 600 level to come down towards 24,900 level and consolidating. So the market is spending in this range, and it's time. It's a matter of time the market breaks in one of the directions and move up strongly. So we'll wait. We'll have to wait and watch for what's going to happen. So that's about Nifty technicals. And secondly, we'll move towards the global market scenario. And to begin with the US market, where the S&P 500, you can see, is flat market, just managed to be on the green with the 0.06% gain. And the Nasdaq, however, the tech index is down by 0.5%, suggests there's going to be negative sentiment on the IT market. So if you're going to check on UK market, on the FTSE 100 index, it's also flat like the US market, with just managed to be on the green with 0.12% gain. And if you come towards uh, Asian market, looking at the Japan market, well, if you're looking at the Japan market, you can see the Japan 225 index is the one which has gained impressively with 3.72% gain. So it's a pretty big move for an index, and especially the Japan market, where you don't get to see these kind of moves often. And if you come finally towards the Chinese market, well, if you come to see the Chinese market on the SSC composite index, it's up by almost 0.5%. So overall, on the Asian market, it's a positive sentiment, and that's how we need to analyze and look how the Indian market is going to be. So it's going to be more or less a positive sentiment influence from the overall global market scenario. Now let's go and check how the broader market picture is looking. Well, if you look at the broader market picture, you can see there are about 2,800 stocks being traded. Out of that, 1,230 stocks are advancing as of now, and 1,530 stocks are declining. Well, the difference is 300 stocks with more number of stocks on the decline. So suggesting there is going to be a negative sentiment as of now. However, the difference, if it is more than 500 or 1,000, if you can see visibly a big difference, then the sentiment would be stronger on a trending note. Well, for now it's flat, or you can say slightly down as per the broader market picture. Well, now before we explore a trade, let me just quickly talk about the moving average and how things are placed. So you can see here, uh, the chart is represented by 5 different colored lines, all representing the different moving average, the 10-day, 20-day, 50-day, 100-day, and 200-day. And if you can see here, the most important one being the 200-day moving average. Based on this, if a stock is trading below this, it's considered as weak or bearish, and stock trading above this is considered as strong or bullish. Now it's pretty simple, right? If you get to see a stock is crossing this line and going downwards, and that is the time you can take a bearish entry. And if a stock or index is crossing this line and going up, that is the time you should take the bullish entry. And the exit would be on a time where you get to refer the other moving averages which come into picture. And uh, that's another deep discussion which we can do on some other time. And keep watching my video for that, so that I'll continue discussing on different moving averages and how it works also. Now let's go to the main topic for the day, the candlestick pattern representing the bearish trend. The bullish trend is always with the green or the white candle, and the bearish candle will be always represented by the red or the black candle. Now we can see it's the shape of the candle. If it's a standard one, it's going to be like this, and you can see there is a tail on the top and the bottom. So this is called the upper shadow and the lower shadow of the candle. So this represents the overall the price movement on the opening and the closing level. So the bottom on the bullish candle, the green candle, is where you can get to see the opening, and from here you can see the price has moved upward towards, and this is where it is closed. Now this length represent during that period the high and the low. The price low for the period of the candle. If it is a day candle, the whole day high low is represented by the tip of the candle here and here, and this represents the closing and the opening of the price. Now this is the whole body, and so this is where the maximum price movement has happened. So the bigger the candle, you can see the price has moved that much longer. Now it's just the opposite of this would be the bearish candle. The opening will be on the opposite side. The opening will be on the top of the candle on the bearish candle, and the closing will be here. So rest of the things are the same. So as it is opposite, the price low would be here and the price high would be here. So this represents the whole body, and so based on this, one can analyze the period on which we are looking at, whether it's bullish or bearish. Now in the chart we get to see so many different size, shapes and movements, and so how to analyze that. So let me briefly show you a couple of examples. Well, the first example which I would like to show is the bearish engulfing and the top, and the bullish engulfing on the bottom here. Suppose if you get to see the continuation of green candles, which will be on the bullish trend, and you can see here all of a sudden the size of the candle has become smaller to the previous one, and then all of a sudden you can see the level has not gone up. On the same level, a bigger red candle that is representing the bearish candle. In fact, the size of the body is much bigger than the previous bullish candle. So this represents a change in trend. A bearish engulfing is the candle which these two represent, and you can see followed by the red candle. So this is where actually the trend is getting changed. The opposite of it would be the bullish engulfing. You can see the market is the trend is going down. So there are 2, 3 red candles, and suddenly the size of the candle has become so smaller, representing the bearish strength has become lesser, and then all of a sudden so you can see the big green candle. The body of it will be bigger than the previous bearish red candle, and you can see they are in the same level, and this is where the U-turn is happening, and this followed by another green candle confirms there is a bullish engulfing which is happening. Well, this is another example, and you can see this is a bearish move. There are different sizes, but it's going on. The level is changed, so this is not a bullish engulfing. So here you can see the candles have become smaller, and then you can see one green candle here, pretty big one, and followed by another big candle. So once we have this, this represents the kind of a bullish turn. So it's a bullish counter attack. So we are only seeing a portion of the chart here, and if you this should be followed by the actually overall trend. You should see the trend is getting changed, so you should have that in mind anytime the trend might be getting changed. So if you have a good support and resistance level already marked up, and this is coming towards the support level, and that is where you should be alert. And if these things exactly happen and confirms that bullish move, so this candle represents the stop loss, and once you take an entry on the second green candle here, and the lower of the previous candle should become the stop loss for you. So you can see here how the candle has moved and given a good profit here. Now there are other questions which come on the out of the topic, where how to exit, and that we will discuss on some other day, or you can ask me questions on my comment section of the YouTube channel. I'll be happy to answer. So let me just go to one more example, rally. You can see the rally is moving up, the strength here and there, it's becoming weaker. And once it comes to the moving average line, again it bounces. And then again it moves and consolidates and touches here and again moves. And again consolidates and touching here, again moves. So as long as it's not breaking the moving average, these are the different levels one who has missed the bus can take a new entry, and you can see this is continuously going on. So this is one beautiful rally chart you get to see here. Well, this is another place, an important place, where when the market is consolidating, if you're seeing the stock or index has not moved much, either it's not given any trending movement, bullish or bearish side, it's just within one small range, and you can see these kind of candles. There is a red candle and a smaller green candle and a green candle, and here. So it's not going out of the range, so you are unable to make out what can be done. And after this line, suddenly you can see some slight bearish movement, and you are sure about breakout or breakdown is happening. And if you ask me, before a breakout, generally it takes a little dip and then it moves up aggressively. And you can see after this big bearish candle, which people may think, okay, we are going to the bearish mode, and that is where exactly one big green candle is coming and followed by another green candle. So this is called the piercing pattern. Then you can see a solid bounce, and you can see it's crossing the high of the consolidation level, and the rally will continue. Well, the candle pattern is a very vast subject. One has to spend a lot of time studying the chart, and this definitely cannot happen overnight. You start using the chart to take your trades, and I'm sure in a matter of time you will learn most of it. So there is no end for it, because if you look at the size and shapes and the permutation combination, there are so many concepts, so many different things are there in the studying the chart, looking at the candles. So I will definitely continue discussing on this topic whenever I get a chance in the future. If you have any questions, please ask me on my comment section of the YouTube channel. I'll be happy to answer. And also, you can join my Smart Trade Circle community if you want to learn more of it. So let me just quickly see whether any trades are available to execute using the bull spread strategy today. At least one of the strategy I will try to add up in this video. So if you can see, the market opened somewhere here at 25,140 and gave up its gain about 100 points and consolidated and started moving upwards. So if you are following some levels to refer, and then this would become pretty easier. So what we can do is we can refer the option chain chart and see how things are placed. So if you look at here, I'm referring the 24th July chart. Studying the Nifty index, 25,131 is the current spot. And if you look at the nearest level is 25,150. And on the left side, you can see the call open interest is there, 1 crore 48 lakhs, and on the right side you can see the put open interest 81.7 lakhs. So you can see comfortably the difference between these two is a big margin. So more of a call open interest suggests there is a big resistance developed on this level. So if you look at one more 25,200, you can see 1 crore 91 lakh is the call open interest versus 60.7 lakh put open interest, suggests one more stronger resistance is there. So for a day trade, definitely you can keep this as the resistance level. And if you come down here, 25, 100, more or less, you have 1 crore 72 lakh call open interest versus 1 crore 92 lakh, showing the margin is less. So more or less, it's kind of equal fight. So there's going to be a fight between the bulls and bears on this level. And if you come down here on 25,050 or 25,000 level, you can see on the left side call open interest at 51.6 lakh versus on the right side 1 crore 64 lakh put open interest, suggests there is a very strong support is there. So a clear picture of range between 25,000 versus 25,200 is the level we need to watch for our trades. So closer to 25,000, we can perhaps look at taking a bullish trade, and closer to 25,200, perhaps we can look at bearish trade based on the intraday. The bigger picture is the market bullish, and within that, on a shorter period, it's on the bearish mode. That's what we are seeing. So 24,900 is not breaking in the last several sessions. So it's the bigger range is 24,900 and 25,300 level. So for the week, for the next 2 days, I presume 25,000 to 25,200 is the level we need to watch out for. So now if we go back to the chart, so we are in between the 25,200 and 25,120. So this is a kind of a no zone trade. On the, if you have seen here in the morning around 9:45, the level dropped to 25,092. So that was the closest towards 25,000. So that is where somewhere there we should have executed the bullish trade. Now, anyway, if you are executing a bullish trade somewhere here, ideally you should buy a call option closer to the spot, which is 2,500, and then sell a couple of 100 points away a call, say around at 25,300 or so. Let me just show you on the notes. So this is one of my favorite strategies, bull spread, because this works in more or less most of the market condition. What is a bull spread? You buy a call closer to spot. Also, you buy parallelly, sell a call 200 or 300 points away from the spot. Well, there is no rule as long as you're keeping a distance in selling one leg and buying, and that becomes the bull spread. Generally, in the beginning of the week, when the premiums are high, perhaps you can look at keeping a distance of about 300, 400 points. As and when the market, as and when the week progresses closer to the expiry, you can keep about 200 points as the distance. So today, if we are looking at the spot is In the morning, I would consider, say, spot is 2500, then buy call of 2500 and sell call of 25,300. Now, what we need to do is we need to keep a stop loss first of about value wise, say 500 rupees, and ideally, if you are looking at a market moving off about 100 200 points, I will show you in the actually putting it on a basket and see how it works. So let me first explain how it works. So if you are keeping a target of, say, about 1000 rupees, then you should look for a minimum of two lots on this trade, and above 510 is fine, and exit first lot at about 500 rupees profit, and exit second lot keeping trailing stop loss of 200 to begin with, and then increasing it as and when the market is going towards the 1000 rupees target. Now, the advantage of trading with two lots is because of the volatility. If you get to see on one point the profit, and if the market reverses, and if you don't book, and the opportunity is lost. So that is what's going to happen if you're trading with just one lot. And I would definitely not recommend to trade with one lot, because you will lose the opportunity. And at the same time, if you're trading with two lots or above, you can book the one lot or the 50% of your lot size as soon as you see some profit, like 500 or 400, you just cut off. So you're assured of that, and then you're keeping a trailing stop loss. And if the market reverses, the 200 stop loss is hit. So 500 and 200 is the profit for the trade. Or if the market is trending on your side, you can continue maybe catching 1000 or 2000 rupees profit based on that particular day's performance. So this is how it works. And on the worst scenario, if the market reverses the minute you execute the trade, 500 rupees is the stop loss per lot you should be looking at. So this is a bull spread. Let me take you, well, let me create a basket here. So Nifty 23rd July. So you're buying the 2500 call, it's around 85 rupees, and then you add 25,300 call of the same series, changing it to the sell mode. Now, one we have a buy and one we have a sell. 2500 is on the buy, which is closer to the spot. So this is the primary trade, and 25,300 is the buffer trade to protect this trade. So combined together, this becomes the bull spread strategy. The margin is, you can see, pretty less, and you can go with at least two lots and above. So if you analyze this, the max profit, you can see if you're carrying this until the expiry, the maximum is 9,500 and the max loss is 5,400. Well, anyway, we are not going to look at that maximum. We will try to end the trade within the day. However, one who thinks he can take risk and sure about the trend which is going to be bullish on the next day can continue this. However, let's right now talk on the intraday perspective. So if you're looking at after taking the trade, if the market goes towards 25,272 or so, you get about 4,800 rupees profit. At the same time, if the market comes down towards 25,000, there is going to be 3,500 rupees loss. However, we have talked about the 500 rupees stop loss. So if the market is going against us, it doesn't matter, just exit with 500. One who's slightly aggressive and take the can afford 800 rupees stop loss is also fine, not more than 1,000 or so, because it becomes a pretty risky trade in the long term. So we need to calculate the number of trades which we are able to take in the whole month, and on the whole month how much profits we are going to make. So if you're keeping this kind of a discipline, and there are definitely days where you get to see a 2,000 kind of a profit or much more. So that is the time you grab it. And on other days, even if you are getting hit by the stop loss, the stop loss would be less, in fact, by 500 or 800 rupees. So, and that's how you cover up. At the end of the month, I'm sure the return on investment would be much higher than the market average. So, well, friends, that is Bull Spread. If you have any questions, please ask on my YouTube channel comment section. I'll be happy to answer. And on this context, I request you to subscribe to my channel if you're not yet, and like my channel. Also, you can join my smart trading circle on using the description below. And if you want to learn more of the stock market things. So for time being, that's it. And I'll thank you very much. Until I see you next time. Take care. Bye.